Hello and welcome to BFSI.com. My name is Amol Dethi and you're watching a special show of FinTech Diary. I have with me Yashraj Erande from BCG. Yash, glad to have you.
It's a pleasure being here, Amol.
Thank you. To begin with, Yash, I would like to learn from you specifically about the report that you have recently launched on the FinTech side. Couple of points you have mentioned. I will go one by one. One point which is kind of a highlight, I would like you to give us more details about is you make a claim that the funding winter has stabilized now. All over the world, in fact, we had seen a great tragedy with the funding winter. A lot of fintechs, in fact, those who were a great disruptor actually went out of the way and in fact closed their shops. But now when you say, the funding winter has stabilized, what does it mean? Does it mean that the investors are ready to pump in more capital? Does it mean that the investors are also looking at fintech very, very positively and the funding will go up? Please explain.
Good question. The funding winter certainly disrupted the disruptor. But when I say stabilize in the report, what we mean is that there is greater clarity on two aspects. One, how much capital can we anticipate? And two, on what terms can we get that capital? So when the regime change was happening in terms of capital availability through the second half of 2021, there was a lot of uncertainty on how much money can you get it or not, on what terms. I think that is now behind us. We are nowhere close to the highs of 2021 in terms of quarterly capital allocation. But now in the $7 to $10 billion range, we have stabilized. We have seen that over the last several quarters. And increasingly, the terms of investments are also getting clearer about predictability of the business model, economics, and so on. So that's what I mean by funding winter stabilizing.
Okay. I will come back to you, but there is one more claim which is very interesting that you said is, obviously we have seen a great rally in 2020, 2021, specifically in fundraising, not only in fintech, but the whole startup space. Yeah. Then it reduced slightly to 2020 and again reduced drastically to 2023. But another claim that you have made is now 35 to 40% uptake by 2030, right? Do you really see that upside in the next 7 years?
Yeah. So today, the penetration of fintech revenues of the total banking and financial services is in some low single digits. India is probably at around 6%. Okay. That number a few years ago was actually 2%. And I'm literally saying just immediately post-COVID. So this penetration, if you look at global benchmarks, with slightly more mature economies in terms of fintech ecosystem, they are in high teens. If you look at the headroom which is there by looking at global benchmarks, and if you look at the growth rate, which we have seen in the last 2 years of fintech revenues, which has been annualized 50% per annum, I think there is no reason why the fintech contribution of Indian financial services revenues can't hit 20%. Okay. And that would inherently mean a growth in high 30s. Okay. So I think that gives me a lot of macro confidence that it is possible. I think at a micro level, there is one big shift which gives me more confidence in this move, which is that today the focus of fintechs is to grow together with incumbents. Okay. So this early on, where there was a fight between an incumbent and an attacker, and there was always a question about whether fintechs are friends or enemies or frenemies. That I think is getting more and more settled, and it is clearer that the incumbents, with their scale, with their cost of fund, with their regulatory capabilities and compliance, have a certain advantage. And fintechs, with their agility, with their customer focus, with their technology orientation, have a different advantage. And it is better if they are able to work together. So again, it gives me comfort that if you are not trying to disrupt each other, but you are trying to figure out a way to serve the customer really well and work together, there is a lot of headroom for growth.
When we look for the 35 to 40% growth specifically over the next 6 years.
Correct.
In fact, there is also an estimation which many economists have made that India's GDP will be doubled in next 5 to 6 years, specifically by 2030. Where exactly the funds will come from, specifically in this fintechs? Because we are going to see a great rally if we see a 35 to 40% of growth, where the money will come from. And also, what is going to happen with the existing funds? Do you think that they have more potential to raise the funds from the existing investors now?
This actually is a very profound question. Okay. If I just take a very dry view of the past, India has not seen the amount of money coming into Indian financial services as what would be required to really fund these businesses. So I will be honest, I have not seen that much money come in. Okay. Last year when we had done this analysis, we actually felt that we are there's a shortfall of 40% of capital, which is required versus what is available in the next 5 to 7 years, not even in the next 1 to 2 years.
Short of 45% of capital.
There's a shortfall. If I look at historical data, I think therefore it's imperative that some structural changes are brought about in terms of India attracting capital. What is my strong hypothesis? I think I have a strong hypothesis that the private capital market in India has not seen a lot of participation from Indian long-term pools of capital, particularly pension funds, insurance companies. So what I call as patient capital and annuity kind of capital providers. I think first few moves in terms of opening that up through the right regulatory framework is there, but there is a lot required to be done. Today, we hardly have 3% of alternates which are invested for by insurance companies. So it's nothing. That number should be 14-15%. So that's one area where I think there is already a pool of capital. It has not accessed the private markets or private equity in this business.
So you're saying the capital is available there,
yeah,
but it is not coming into the market. Any reason why?
See, there are two reasons. The first reason is that just the safest asset class in India, which is Government of India securities, that is generating high single-digit returns, 7-8%. Right. So the hurdle on how much return is required from a slightly riskier asset is pretty high.
Yes.
So in a way, you can say, agar wahan pet bhar raha hai, to how do you really motivate people to go outside that, right? I think there one of the things we are seeing is that now, if we see good IPOs happening, there will be confidence that even private markets can generate good returns in high teens. That's one. I think second is policy and some I would say accounting guidelines. There it is about streamlining some wrinkles which exist in terms of how these investments are accounted for, whether you can create a pooled vehicle or you can do individual accounting. Some old regulations exist. Those wrinkles need to be ironed out, and discussions are on. We are a progressive country, so we will get there.
But when you estimate this growth of 35 to 40%, I'm looking at this number again and again because that sounds really interesting and quite positive also.
Yeah.
What kind of capital do you see, coming up into the fintechs, and where will it come from? Any geographies or something like that?
I think there's. I'm expecting a lot of capital to come from Northeast Asia, which is Japan, Korea. I'm also expecting more capital to come from the Middle East and GCC countries. See, US itself is going through a certain transition, and it has been a source of capital. It will remain a source of capital. But if you find on a risk-adjusted basis ability to generate 10% dollar returns in US, then India's attractiveness changes, right? But if you take Middle East, if you take Japan, where such returns are not easily available on a risk-adjusted basis, then India becomes a very attractive destination. And you can see that it's in the news, the amount of interest these businesses are garnering from the pools of capital that I just mentioned. So I think from those sources, let me add a third source. The third source is going to be retained earnings of the businesses we are building. In the last 1 year, the percentage of profitable fintechs has gone beyond 60%. I think it's now pushing 65 or 67%. That number was closer to 30% just about a year ago. So as profitability starts improving, you can fund your growth with your retained earnings, with the money that you generate. I'm really banking on that becoming an important source of this growth.
I copy you. A lot of fintechs have started focusing on profitability, sustainability. The GMV numbers perhaps have been reduced now in their balance sheets, which they used to, talk about earlier quite positively. But when we are saying this growth, and when you're saying all these investors from the North America and different countries are very positive, can we safely say that fintechs will have a better run now because the funding will be available, perhaps not as good as what happened in 2021, but not as bad as what happened in 2022, 2023?
For sure. Look, but for things that I would call as completely unknown unknowns. I mean, if you have a big war, if you have a major geopolitical disruption, I think those are shocks that can easily create disruption for a few quarters in the journey. But if you take a 10-year view where these shocks can be absorbed, I have no doubt that the future is very bright.
What has changed, Yash, in last maybe 2 years? I do not want to take a long, historical view also. And how is it going to benefit for this fintechs? Because what I clearly remember is everybody wanted to do a heavy competition with the banks. That dream has gone off completely, and now they're partnering and collaborating. So is that model working now, and is that the path to profitability for the fintechs?
I think that is a good path to take. The reason is that incumbents as well as new attackers or fintechs, I wouldn't call them attackers anymore, but the newer players, they have started finding comfort in their business models. The newer startups have understood that their strength comes from modern technology, modern data science, agility, and customer orientation. And the incumbents have understood that their strength comes from scale, from being very used to being a highly regulated company and having a large franchise. So working together, I think that has been, if I may say, one of the biggest changes that has happened in the last few years. It has had many trickle down benefits. For example, if you are a new startup and you're going to work with a 50-year-old very large incumbent player, by definition, as a startup, you'll have to improve your governance standards. So that has changed. There will be a greater burden on you to be economically viable. Otherwise, you will not qualify for many of these RFPs. So naturally, you need to be profitable. And with scale, it becomes even more important to be careful and be, I would say, alert to the changes in law which is happening in India, whether it is the DPDP Act and so on. So I think the big change is just clarity of business models, which is helping everyone.
Okay. No, that was meaningful, Yash. But regulators are active. The compliance burden has gone up also significantly for a lot of fintechs, which they never expected it will come very soon. Do you think that will be also one of the speed breaker going ahead in the growth?
So it is, what is an advantage for somebody will be a disadvantage for someone else. I think there are, I can say for certainty that there are some very forward thinking, very resolved, very sorted businesses, founders, investors who don't think that being well regulated is a negative thing. They actually think that it's a cost you pay for earning the trust of large pools of capital. If somebody is going to give you $10 billion, it will not come if they can't trust you. So I think those entities are actually going to benefit enormously, because they will start sucking in much larger volumes of capital and become the preferred choice for partnerships. I think those who feel that the money lies in arbitrage on regulation will find these changes to create some disruption. That's par for the course.
Do you think now the rally in the Indian fintech is over, where everybody used to chase customers and acquire them free of cost, and nobody confessed that the cost of acquisition per customer is very high, though it's digital? Do you think that rally is over, and now they will look at customers, with a cost and a value proposition?
See, I think the customers will realize that these new startups are now approaching them with more economically viable products, which means maybe not enough freebies, but it hopefully also gets compensated with better service and a better experience. So just burn and grow, that if you want to, I don't know if it's a rally, but the burn and grow mindset is over. But earn and grow will remain, and for a simple reason. I think Indian businesses are, it's very hard to make a case on viability in a country like India, where 1% of India is actually equivalent to the US GDP per capita. There, the rest of it is not. So in a country like India, without growth, there is no business case to be made. So you can replace the word burn with earn, but you can't replace the word grow. So grow has to happen. I think it will happen with better proposition.
Okay. So what kind of models do you think the fintechs will adopt now? Will they spend cautiously? Will they acquire customers cautiously and go ahead with only the collaboration model, or they will stand on their own?
No, I think they will do both. The one thing that will be common across all models is that in the base of customers that they have acquired, and which are now very large bases, they will use new tools of data science, personalization, hyper personalization, AI and ML technologies to go deeper with the best customer. So to give an example, if I'm a fintech, I have acquired you, and I know in 3 months that you are actually a fantastic customer, then every incremental OPEX should be in getting more business out of you, instead of trying to go and find another customer who's not necessarily as good as you. So this pivot towards deepening the relationship is where the incremental dollar will get spent. The more data science and technologies will get invested.
Interesting, Yash. My now last question specifically is about the profitability of the fintechs, which everybody is betting on. We have number of fintechs, right? And many of them are actually replica of couple of fintechs. Like we have, I mean, so many or dozens of them in payment aggregators and PG. Similar is the case in the payment and lending as well, right? Which segment of fintechs will become profitable? What will happen to the fintechs which are not going to be profitable? Do you think that the investors will still bet on them? And how do you see the overall profitability and sustainability changing the rules of the games for the fintechs?
In my mind, every segment will, and actually already has profitable fintechs and unicorns. So there are 5 segments. There is payment tech, lending tech, insurance tech, wealth tech, and fintech SaaS, which is software as a service. There isn't a single segment that doesn't have a unicorn in India, and there isn't a single segment which doesn't have some profitable players in it. So line of sight to becoming profitable exists in all segments. I think it is going to be relatively easier in credit, relatively easier. Actually, perhaps the word is not easy, but established profit pools are in credit, established profit pools are in wealth. Insurance as well, but it's a longer gestation bet. And fintech SaaS is a completely different play. It can be quite profitable, then, but you need to be able to serve developed economies at those price points. So, I mean, we'll see. I think in payments also there's path to profitability as long as you can start monetizing through what I said, cross sell and deepening relationships.
Sure. Noted your points. Thanks for your time and sharing
Thank you,
all
Mal.
this information, Yash. Thank you so much.
It's a pleasure talking with you.
Thank you so much for watching FinTech Diary on etbfsi.com. Stay tuned, stay connected to etbfsi. Thank you.